Hey guys, and welcome back to the channel. Today we're going to be deeping down into ServiceNow or stock ticker now. Now, at a high level, think of ServiceNow as the workflow operating system for large enterprises. So, like for example, when a Fortune 500 company wants to move away from email chains, spreadsheets, legacy IT systems, ServiceNow is often the platform they choose. This is why this stock trades at a premium. Investors are paying for the company that sits right in the middle of a digital transformation and AI-driven automation too. Now, the goal of this little bit of a stock analysis is to understand the business model, analyze some growth margins and cash flow, but also evaluate the risks and competitions within the stock. Now, of course, if you do enjoy this, leave a like, hit the subscribe button, comment down below if you've already invested in this, and remember, this is not financial advice. Please do your own research because when you invest, your cash is at risk and you could lose money, or, for example, you could become more vulnerable. But let's get into this, okay? So, as you can see here, ServiceNow has kind of dipped from its all-time highs. It's at $108 a share at the time of recording. But as you can see, it's actually reached the highs of 200. Now, it does have a market cap of roughly 111.28 billion. Does not pay a dividend. It was IPO'd in 2012. Now, this is a large cap, high multiple SaaS name. But this is the problem. Because, for example, this time we've invested, everyone wants to focus on a dividend. Especially when the AI bubbles or the AI problems are arousing. Everyone is looking for some security. But this is a growth and compounding story, not income. And the market is clearly treating this as an asset, as growth, with a trading PE of the mid-60s, forward PE in the low 20s, with an overall growth of around 22% year on year, and net margins in the low teens. So from the start, you're definitely not buying a cheap cash flow stock. You're buying a premium growth platform that the market expects to keep compounding year on year. But what does ServiceNow actually do? Well, cloud software for digital workflows replacing legacy systems. Core modules is the ITSM, ITOM, ITBM, CSM, and HRSD. Security, ops, asset management, low code, no code development, automation, and analytics. So this is like the engine room of the investment case for the stock. You know, the ITSM is the modern help desk incident management. This is where ServiceNow actually started its company. Now you've got the ITOM and the ITBM, which is the managing infrastructure operations and IT products. You got the CSM, which is the customer service workflow, cases, escalations, and field service. You got the HRSD, which is the HR service delivery, onboarding, employer requests, and payroll queries. You got security ops, which is incident response and threat workflows. You got asset management, which is of course tracking hardware, software, and licenses. Now, all of these do sit on the same platform, the Now platform. That shared data model and workflow engine is crucial. It means one customer is in, adding new modules is incremental, not a full re-implementation. This is why the net revenue retention has historically run above nearly 120%. Existing customers expand faster than they churn. Now, from an investor lens, each model is an additional ARR per customer. Now, of course, the platform architecture is a high cross-sell, low incremental cross, with the result being high gross margins and strong upsell dynamics. But why does enterprises choose ServiceNow? Well, this is where the moat in the company is. With a deep integration, ServiceNow connects its IT systems, HR tools, security platforms, CRM and more, and once those integrations are built, they are not casually ripped out. With a high switching cost, replacing ServiceNow means rebuilding workflows, retaining thousands of employees, migrating data, and reintegrating dozens of systems. That's not a swap the license decision. It's a multi-year transformation risk. And mission critical is if ServiceNow goes down, ticketing, approvals, onboarding, and customer service can grind to a halt. That's why renewal rates sit above 98%. And lastly, their security is enterprise grade. It tables stakes when you're selling to banks, government, and global corporations. Now, for this stock, this kind of translates into a low churn, which is kind of like the predictable revenue. For HNR is the growth from existing customers, and pricing power is the ability to charge for AI, new models, and enterprise deals. This is why investors are comfortable paying a premium multiple, that the revenue base is sticky and compounded. And let's have a look at the leadership and scale, which is kind of like the Bill McDermott effect, for example, because Bill McDermott is the big part of the bull case. Now, he took SAP's market cap from 39 billion to 156 billion. And he's known for enterprise sales, execution, and deep C-suite relationships. Now, under his relationship and leadership at ServiceNow, his sales organization rebuilt around a large multi-year, multi-product deal. Platform positioned a mission-critical, not nice to have, with global expansion accelerated. The Gen AI pushed the center of the product roadmap. For investors, this strong leadership mattered because the odds sustained execution, but also because it actually supported the large ownership deal volume that it wanted to be, and it helps justify the high expectations backed into the valuation. But how did it go from 1 billion to 13.4 billion? Well, between 2010 and 2015, a lot did happen for ServiceNow. They disrupted the legacy ITSM. It replaced its old prem systems like the BMC Remedy with faster, cloud-based ticketing and workflow automation. They executed land and expand projects, which was to start with the ITSM, then expand onto the item, the CMDB, the asset management, instant change management, and each model deepened with the relationship. But what truly accelerated ServiceNow growth? It was also the same time that enterprises were beginning their first major digital transformation push, and between 2010 and 2015, organizations started replacing its manual, email-driven processes with the digital workflows, and ServiceNow quickly became the default engine powering these transformations, embedding itself into the operational fabric of the large companies. And by 2015, these three forces, the cloud ITSM disruption, platform-driven expansion, and the rise of enterprise digital workflows propelled ServiceNow into the 1 billion annual revenue, firmly establishing its dominance and setting the stage for explosive growth that followed. And that was the workflow explosion era. 2015 to 2020 is where the story shifts from the IT to the enterprise-wide. The key moves like the launch of the HR service delivery, the customer service management, the security operations, and the early automation in AI. Financially, the revenue grew from 1 billion to 4.5 billion, and the renewal rates grew above 98%. Subscription model drove predictable recurring revenue and the global expansion into Europe, APAC, and the Middle East. For this stock, this era proved that ServiceNow could expand horizontally across departments and the platform could scale internationally. Automation AI could also increase the stickiness and upsell, but this is the foundation for today's AI-driven narrative. But the Bill McDermott's hypergrowth era came from 2020 to 2025. Now, the drivers of the hypergrowth is kind of where the current valuation really comes from. With the post-COVID digital operations, the remote workflows, digital onboarding, the automated approvals, ServiceNow became the default automation engine for the Fortune 500. With the new product lines with the creator workflows, employer workflows, customer workflows, industrial-specific solutions for finance, telecom, and healthcare, it helped with the AI and Gen AI intelligence embedded into the ticket classification and workflow automation. And with that, the mega deals came with $10 million plus annual contracts, multi-year enterprise-wide deployments. This era explains why the market is willing to pay a PE in the 60s and the price to sales around 8 at 8.5. The company has shown it can triple its revenue in 5 years while maintaining strong margins and cash flow. So why do the gross margins sit and retain around 75%? Well, once the platform is built, each new customer adds the very little incremental cross. Now, the shared infrastructure and data model means that new modules reuse the same foundation. High retention, long contracts reduce the need of constant reselling. With that, the gross margins sit around 76 to 77%. Excellent by the SaaS standards. For investors, the high gross margins matter because they provide room for heavy investment in sales and R&D. They also support the strong cash flow and make long-term operation leverage possible. But why does operational margin sit at only 13%? Well, despite the elite gross margins, the net margin sits around the 12 to 13% mark. That's also because massive sales and marketing spend. So, for example, when enterprise sales is expensive, multi-year negotiations. Now, the C-suite involvement in global deployments and customer integrations, they also spend quite a lot in the marketing sector, with the expense of actually being at $1.216 billion. They invest heavily in the enterprise sales teams. They've also got the heavy R&D with new modules, AI automation, industrial solutions, all requiring ongoing investment. They also have the acquisition costs by buying new workflows, and AI companies add integration and restructuring expenses, like the one that is on the screen with Armus coming into the integration. But of course, it is a growth first strategy. Management is clearly prioritizing scale and product depth over maximizing short term margins. For this is a double edged sword. Positively, it fuels future growth and strengthens the moat of the stock. But negatively, it means if the net revenue growth slows, margins could also compress quickly because of the cost base is high. But where does the ServiceNow spend all its money? But why? Well, the sales and marketing is where the largest expense lie. This is the engine between $10 million plus in deals in global rollouts. They also do an R&D, of course, with the AI workflow automation getting improved. They also get the G&A, which is the global expansion compliance support functions. From this, you kind of want to watch whether the S&M as a percentage of the revenue trends down over time, which is the operating leverage, of course, and whether the R&D spend continues to translate into new modules and AI monetization, just not experimental. And why is ServiceNow's cash flow elite? Well, the subscription model, of course, is the recurring revenue because it's predictable cash flow. And the cash flow drivers is because of mostly due to subscription model because it's high visibility and, like I say, recurring revenue. But they also do two different ways. They've got the deferred revenue, where customers pay upfront for a multi-year contract, boosting operational cash flow. But they've also got high gross margins. More of each dollar of the revenue can drop into cash. This is why the metrics look like for P to free cash flow around the low 20s. Now, don't look outrageous for a company with this profile, but strong cash flow helps fund the R&D and acquisitions, support buybacks and shares, and provides downside protection in tougher micro environments. And talking about buybacks, where does it spend the billions on buybacks and acquisitions? Well, in the 2026 Q1, they actually did 2.23 billion in share repurchases. Of course, this supports the EPS and offsets stock-based compensation. They spent 1.33 billion acquisitions in Q1 2026 because it buys back startups, workflow automation companies, industrial-specific work tools, which increase the acceleration of product innovation. But why ServiceNow balance sheet is one of the toughest in AAS? Well, the cash and investments are around 9.6 billion combined. Now, the debt to equity is around 0.21, which is low leverage, and of course, strong equity growth over the recent years. This gives ServiceNow the opportunity and optionality. Now, it can keep investing heavily in the AI and products. It can also weather the macro shocks. It can continue buybacks and acquisitions without stressing the balance sheet, but also with the low debt, it can do a lot more with its investments and cash. Now, why is 8.03 in deferred revenue a good thing, or is it actually a bad thing? Well, in my opinion, deferred revenue is not actually a red flag here. It's quite a good feature of their model. It tells you that customers are actually committing multi-year to a platform. Future revenue is already contracted in, and cash has already been received. So for the valuation, this supports the idea that ServiceNow revenue base is high quality and durable. But how is their profitability involved, and which drove each phase? Well, 2015-2020 margins stabilized. Growth margins, of course, were roughly around 75%, or sometimes exceeded, and subscription renewals drove predictability profit. In 2020-2023 was where McDermott made efficiency the main priority, with the net income accelerating, operating margins expand, and despite heavy investment, it pushed the net income to 1.4 to 1.7 billion. And then 2024-2025, net income reached the 1.748 billion mark, proving the company can both be high growth and profitable. And ServiceNow is no longer a profit later story. It's a profitable growth model which supports the premium valuation more than the cash burner would. But why does the EPS fluctuate and still trends upward long term? Well, EPS drivers are one of three things. It's either the rise in net income, margin expansion, aggressive buybacks offsetting dilution from stock-based compensation. Short-term EPS can move around due to one of three things: acquisition costs, one-off items, and timing of buybacks and compensation. But the trend is upward, which is what matters most for long-term investors. But overall, the EPS rises because ServiceNow is transitioned from the pure growth model into a profitable growth model, and where its scales, efficiency, and disciplined capital allocation work together to steadily increase shareholder value. So, what are the real risks, and what's understandably not the generic ones? Well, the key risks are expense pressure, high fixed cost base. If growth slows, margins can compress quickly, as mentioned in this video. Acquisition, integration, or risk, so culture clashes, product overlap, customer confusion. You've got high current liabilities, so largely deferred revenue, but still the obligations that must be delivered against. Competitive pressure like Microsoft, Salesforce, work all day, all pushing into workflows and automation. And evaluation risk. PEs in the mid-60s. PS is around 8 to 8.5, priced for near perfection in the execution. Now, for a buy today, these risks are not theoretical. They're central to the decision of if you're going to be paying them high multiple stock. So any wobble in growth, margins, or competitive positioning can track and trigger a sharp re-rating. So why is ServiceNow dominating the enterprise workflows, and why is nobody going towards, like, for example, the Microsofts, the Salesforce like we mentioned? Well, like mentioned in this video already, it's mostly because there's deep integration across its IT, HR, security, customer service, and finance products. And because of that, the platform strategy is crucial, why every customer is loving it, because every new module strengthens the core. And the world-class enterprise sales organization under McDermott is getting a lot of reputation. This is why so many analysts and AI models still rate now as a strong buy with upside targets of between 25 to 30% range from current levels. So understanding the premium valuation, like we mentioned, it's a very high PE stock. It's got a stock of PE of 64.32. Now, like I say, and like I've mentioned, the trailing PE is mid-60s, forward PE is low 20s, price to sales is 8.5, and price to book is 8 to 9. The forward PE is where it implies the strong expectations in earnings growth. This tells you where the market expects to continue 20+% revenue growth and margin expansion. The stock is not priced for stagnation, it's priced for ongoing compounding. If these expectations hold, the valuation can be justified. If they don't, the downside can be sharp. So is this ServiceNow worth its premium valuation? Well, in my opinion, the bull case at these levels are one of a few things. If the revenue growth at 22% year on year with strong NRR and low churn keeps going, that is good. Net margin at 12 to 30% with room for operational leverage. It's got a strong balance sheet, low debt, high cash. Its AI and Gen AI provide a clear monetizational path on top of the existing contracts, and a lot of institutional ownership is high, which consensual targets sit meaningfully above the current price. But with any stock, there are risks, and that is where the valuation already priced in significant AI-driven acceleration. Stock is still below its 200-day moving average and down heavily from its 52 weeks highs, suggesting the market has already punished prior over-optimization. And of course, with the optimism, if ServiceNow can't deliver, it isn't going to go anywhere soon. And of course, any slowdown in the CR, PO, and AI adoption or large deal volume could trigger further derating. But in my opinion, it does have opportunity to be a long-term compounder. Now, most enterprises still run critical processes on email, spreadsheets, and legacy systems. Now, ServiceNow, of course, is trying to replace those with structured automated workflows. The new models across the IT and HR customer service could help with higher retention and strong upsell dynamics, creating the compounding growth. If you believe that the workflow and AI automation theme over the next decade, then of course the ServiceNow is one of the purest plays. Now, of course, signals to watch before and after buying. Now, if you're considering to buy now at the current levels, in my opinion, you need to kind of watch the operational margin trend. Expanding equals good, compressing equals as a warning sign. AI adoption metrics, uptake of AI-powered modules and now assist. Large enterprise deal volumes, number of size of 10 mil plus contracts. Acquisition execution, are deals integrating cleanly. Cash flow stability, and the competitive landscape. This is where it will tell you whether premium multiples remain justified. And in my opinion, is ServiceNow a buy? Now, the overall verdict is balanced but clear. It is a high quality, high growth compounder. The business quality is very high, the moat is strong, the growth is 20+% revenue, expanding product sets and AI tailwinds. The profitability is solid, with room for leverage. The balance sheet and cash flow is excellent. The valuation is demanding but not absurd. So here's my honest answer. If you're a long-term investor who believes in enterprise workflow, automation and AI, you're comfortable with the volatility and high multiples, then with it being 30% down from its 52-week high, now can be very reasonable to buy at these levels, especially on the weakness on the stage entry. But if you need more margin of safety and hate the valuation risk, this stock is to watch closely, not chase blindly. Wait for either a pullback or clearer confirmation that AI-driven growth is accelerating. But I hope you guys did enjoy this little video on ServiceNow. And if you did enjoy it, leave a like, hit the subscribe button. Comment down below if you've already got this stock invested, and any feedback would be appreciated. But I hope you guys did enjoy, and I'll see you on the next one. Goodbye.